Welcome back to Chapter 3 of our series about house hacking in Milwaukee. As promised, today I will be covering everything that has to do with funding and financing real estate transactions. Now, this is not specific to house hacking transactions only. It applies to most general real estate transactions. But if you're interested specifically in house hacking and you have not seen Chapter 1 and Chapter 2, I would suggest you start right there, because otherwise you will be missing some of the context. I will put a link up here that will get you to Chapter 1 and Chapter 2. And today we have a lot of ground to cover about financing, so let's get started. All right, my name is Marcus Auerbach. I'm a local real estate agent with Keller Williams here in Milwaukee, and I've also been a very active real estate investor for over a decade now. And one of the key advantages that you have with house hacking is that you can do it with a very low down payment. So as an investor, you're generally required to put down between 20 and 25% depending on the property type, because you are not going to live there. If you're going to own an occupied property, if it's going to be your primary residence, the bank is going to offer you a variety of different loan products that all have low down payment options. So that makes it a lot easier to get started. Another key perk of house hacking is that it is repeatable. So after 1 year, you can go and buy another primary residence for yourself. You are going to have to move in there, but you can do it again with a very low down payment. Next, let's talk about interest rates, because that is going to be driving your cost of financing. Now, because you're owner occupying and you're low risk, your lender is going to give you very attractive interest rates compared to a non-owner occupied investment property. Rates are very low right now, under 3%. I think I've seen as little as 2.75% on a 30-year fixed rate. And to understand how crazy low that actually is, take a look at this chart. You can see here the historic development of mortgage interest rates over the last 40 years. And when you go back to the early 1980s, you can see that mortgage rates have peaked out at over 18%. That's like credit card debt. I cannot even imagine to sign a mortgage for over 18%. Now, the reason this is important is because a low interest rate lets you buy a property with a lower monthly payment, or you can buy a more expensive property with the same monthly payment. If you want to stay on top of interest rates and other developments in the Milwaukee market, take a look at my monthly market updates. I'll put a link up here. All right, before you can go out and buy a house with a mortgage, of course you want to save up for a down payment. And there's a lot of misconceptions around down payments. I'm always shocked how many people are actually under the impression that they need to save up 20% in down payment. That is not the case. Of course, 20% down payment is the gold standard, because as soon as you exceed 20% equity in a property, you are no longer required to pay PMI. And we're going to talk about PMI in just a second. For now, just know that on average, American first-time homebuyers are usually putting down between 6 or 7%. So if you're in the market for a duplex in Milwaukee and you've saved up, say, $15,000, $20,000, you're in good shape and there's many options for you. So what is PMI? PMI stands for Private Mortgage Insurance, and it is an insurance policy that the lender takes out on your behalf to insure the loan against the risk of you defaulting. It covers the gap between your actual down payment and 20% equity. In the case you're defaulting, you're not making your loan payments anymore, and the lender has to file for foreclosure, the PMI and your down payment help to mitigate the losses for the lender. So of course, the higher your down payment and the better your credit score, your lower your PMI insurance premium will be. Just to give you an idea, PMI on a Milwaukee duplex may be somewhere between $150 and $200 per month. The next big source of confusion are credit scores. There's a lot of people out there that are under the impression that they need to have a perfect 850 credit score in order to apply for a mortgage. And that is not the case. If your credit is about around 700, you are generally in good shape. There's a lot of loan products that will go significantly below a 700 credit score. And having a higher credit score does help you with a better rate, but the gains are usually relatively small. So we're talking maybe 1/8% or 1/4% that you can get if you have a higher credit score. So if you do the math on your monthly payment, it's not all that big of a difference. The other misconception is that you need to pay off all your loans, like your student loans, and get your credit score in better shape. Also, that is not the case. Paying off debt is only necessary if your DTI is too high, and we're going to talk about that next. So what is DTI, you're asking? DTI stands for debt to income ratio, and it is simply a metric that lenders are using to determine your ability to take on additional debt. So generally DTIs are acceptable in the high 30s, low 40% range, 42, 43%. And again, it depends on the loan product, which DTI is acceptable for that particular loan. Some have higher limits, some have lower limits. How do you calculate your DTI? I'll illustrate on a simple example. Let's say you want to take out a mortgage that will cost monthly $1,500. And let's say you have a car payment for $100 and you have some other debts for another $400. So your total monthly obligation, including your $1,500 house payment, are going to be $2,000. And let's say your gross monthly income is going to be $6,000. So you have $2,000 in debt service, $6,000 in income. That gives you a DTI of 33%. So your DTI, your debt to income ratio, is ultimately what determines how big of a mortgage you will qualify for. If your DTI is a little bit high, it's not the end of the world. Your loan officer may suggest to pay off a credit card or finish the last 3 car payments that you have left in order to get your monthly debt service down and to get your DTI within guidelines for a certain loan product. All right, we have covered down payment, we have covered debt to income ratio. There is one more thing that you need to pay attention to, and that is closing costs. So closing costs is a bunch of fees that you are going to get charged by your lender at the closing on top of the down payment. So there's a whole bunch of fees in there. There's appraisal fees, there's document fees, there's loan origination fees. And for a typical Milwaukee duplex, it may total up to about $3,000 to $4,000. It depends a little bit on the lender, but pay attention to this because it oftentimes gets overlooked, and lenders that have very, very attractive interest rates sometimes have higher closing costs, so it is definitely something that you want to consider. On top of the closing costs, you will also be responsible for the cost of the home inspection, and that, depending on how many units that property has, is typically somewhere between $500 and $750. So what about property taxes and insurance? Do you have to save up for that as well? There's some good news here. Your lender is going to collect from you a monthly mortgage payment, and that breaks down into what we call PITI, that is principal and interest for the loan, and taxes and insurance, PITI. And the lender takes the taxes and the insurance payment that you make on a monthly basis, and they put it in an escrow account, which is basically a savings account. And when the time comes at the end of the year where you have to pay property taxes, they're going to take care of the property taxes on your behalf. The money is already saved up for you. All right, we have covered a lot of ground, and this has been pretty technical. So if you're still with me, congrats to you. And if you got value out of this video, right now would be a really good time to give it a thumbs up. If you have any comments or any questions, you can put them in the comment section below. I usually try to answer YouTube comments within a day. And of course, you can always send me a personal email. Next, we're going to cover the different loan products. The first loan I would like to talk about are FHA loans. FHA loans have been around forever, and they have a well-earned reputation with first-time home buyers. The typical down payment on an FHA loan is 3.5%, and they are very tolerant on the borrower side. So you can get an FHA loan with the quite low credit score, and you can also get it with the quite high debt to income ratio. So between all that flexibility and the low down payment, what are the negatives of an FHA loan? Well, first off, you're stuck with PMI basically for the life of the loan, so you will always have to make that additional payment every month. And then FHA loans also require an additional inspection that is done by the FHA appraiser. And if the property is a little bit older, the FHA appraiser might call for certain repairs, and that is usually just a week before closing. So a lot of sellers are apprehensive with an FHA loan because they don't want to go through that second inspection. Next up, VA loans. If you're a US veteran and you're eligible for VA benefits, you definitely want to check out a VA loan. They are quite tolerant on the credit score side, But the biggest benefit that most people will list first is that you can get a VA loan with zero money down. There is no PMI, so that is a major difference between the VA and the FHA loan, that you don't have to pay PMI, but there is a 2.15% funding fee which you have to pay at the beginning of the loan. What is the downside of the VA loan? Just like the FHA loan, the VA wants to make sure that you're buying a property that is in good shape. So with the VA appraisal, they're also going to do an additional VA inspection after you've already done your home inspection. And if they find on an older home there are certain things that need to be repaired, they may stipulate that on the seller before they're closing on that loan. Next on my list is a conventional mortgage, usually amortized over 30 years with a fixed interest for 30 years as well. It is considered the gold standard by many. Compared to a VA loan or an FHA loan, the requirements for the buyer are a little bit higher, so you need to have a better credit score and you need to have a better debt-to-income ratio. That also makes you look as a stronger buyer in the eyes of a seller. As far as PMI, it depends on your down payment. If you put down 20%, then you certainly don't have to pay PMI. And as you're going down in your down payment all the way to 5%, some of them do 3%, you will have to pay PMI, but only until you can show that you have 20% equity, and then you can drop the PMI from that point on. Another big difference between a conventional mortgage or an FHA or a VA mortgage is that you're not going to have an inspection by the lender. So you still have your primary home inspection by a home inspector of your choice, but you do not have a secondary home inspection conducted by the lender. And with that, we are finally arriving at the world of adjustable rate mortgages, or ARMs for short. So as the name is suggesting, on these loans, the interest rate can start adjusting after an initial period. So for example, on a 5-year ARM, you have an amortization over typically 30 years. So that's the time the loan is being paid off. But after 5 years, the locked-in interest rate starts to float. It can go up or it can go down depending on what the market is doing. ARMs are usually held as a portfolio loan by a local lender, which makes them quite flexible. For example, we have a local bank here in Milwaukee which will do a 5% down payment ARM with no PMI. So from a cash flow point of view, not having to pay PMI and only having to come up with 5% down payment is very interesting for a house hacker, especially if you're planning to refinance anyways once you hit 20% equity. So these were the most popular mortgage products, but there are more which I'm going to summarize in a category called others. For example, you're going to have a USDA loan with 0% down for rural properties. You have WIDA loans here in Wisconsin, which are state-sponsored, very low down payment programs. You have 203B loans for renovations. You have medical professional loans, also called doctor loans. And not every lender is going to be able to offer you every loan. So it really comes down to sitting down with the real estate agent who knows the market and who can understand your situation, what are you trying to accomplish, and then point you to a lender that is going to be a good fit for what you're trying to do. And I have one last tip for you, which I almost forgot. So if you're saving up for your down payment and you don't have quite enough yet, and so you think you might need to save for another year before you can go ahead and purchase your first house hack, there is the option to accept a gift from a family member. So you will have to provide a gift letter, but most loan products will allow for a gift from a family member towards your down payment. So if you just need a little bit more for your down payment and your parents, for example, are willing to help you out, that's absolutely an option you could consider. All right, this pretty much wraps it up for today. I hope you got some good information out of it. Next time we are going to talk more about real estate nuts and bolts. We are going to talk about the different types of duplexes that we have in the Milwaukee market and the pros and cons that are associated with those. Thank you very much for watching, and I'll see you next time.